one-page handout with a lot of the detail that we'll be talking about, but it's not necessarily on the screen today, that I'll send to you after this webinar. So you can sit back and relax and enjoy it and focus on the content without feeling like you need to take a lot of notes. And with that, let's jump in. As Scott mentioned, accurately so, 100% of business owners will exit their business at some point. And the whole discussion about that we'll be talking about today, and really the reason that I wrote the book that Scott mentioned, was to make sure that business owners do that on their own terms and for the best outcome as however they define it. We'll talk about some of the different ways that my clients have defined a successful outcome in an exit during this presentation. But the goal is to make sure that because it's a certainty, like death and taxes, you will exit your business. We want to make sure that you do it right, you do it at the best of your ability, and that's what we're here to talk about and to help you with. So the two questions that we'll be focusing on today that I think are most relevant and come from the first section of the book are the concept of sale readiness. What does that mean? Why would you want to be sale ready? Does it have any benefits to your ongoing daily life as a business owner? The sneak answer there is yes. And then secondly, how will you know when the right time to exit is? So being ready is important, and also being able to read the tea leaves, to see the signs, to know when the right time to exit are both important things that I think we'll be covering today. Stepping back though for a minute, before we get into those questions, so mergers and acquisitions, M&A, that's what I've built my career in doing. I've been helping business owners plan for and execute a sale of their business, typically smaller to medium-sized businesses, for over 20 years. And if I catalog the reasons that my clients come to me and that we find ourselves in an M&A process, some of the most common reasons are here on this slide. So, you know, the owners are thinking about retirement, or they found some health issues have come up that lead them to want to exit their business. You see industry pressures, things that are changing, that are forcing them to the table to partner with someone to become more strong, and rather than risk being pushed out of a sector or a marketplace. Family dynamics, whether that's, you know, a separation amongst the ownership group, or maybe a change in direction for the next generation that was maybe teed up to step into the business, and they've had a change of heart, or have decided that's not the best path for them. And maybe more often than you would expect, an unsolicited offer from a potential buyer is the thing that really piques my clients or future clients' interest in selling a business. That happens quite a bit, is that a buyer comes to them with something that makes them say, you know what, maybe I should think about pursuing this, given this offer that I've attracted. The commonality with all of these points here on this slide is that these are things that put our business owners in a reactive position. These are things that happen to them, to which they must react. And if they're not well prepared, they can be caught flat-footed. And in these situations, when you're dealing with the exit of a business that most of my clients have spent decades building, you don't want to be flat-footed. You don't want to be caught off guard. You want to be prepared. You want to be able to react to these things if they should come, or proactively begin a process on your own terms, but from a position of strength and preparedness. And we're going to talk about, you know, the sale ready posture, about how your business can be ready, but also just attending a seminar like this that we'll be talking through, being mentally ready about what an M&A process looks like. We'll touch on that later, just to alleviate some of the opaqueness and the complexity that you might feel about an eventual exit process. My goal here today is to help take a number of vague and potentially overwhelming concepts and boil them down to something simple and easy to understand, and something you can feel comfortable with, whether you're interested in selling in the next 6 months, the next 6 years, or the next 50 years. We're going to help you think through and get ready for all those things. But the goal is to be ready and be able to proactively respond to these things rather than be caught flat-footed. So the first place we want to start is the understanding your exit options. And here is one of those examples where this topic, if I said, what are your exit options? You might glaze over in your look back at me because it may feel like it's innumerable and kind of infinite in choices. And to simplify things, we're going to go back to basics here and talk about two main categories, internal and external, and two subcategories within each of these. So internal exit options are very simply employees or family members. Those are the two subcategories. And you can see why they're internal. They are already connected to you and the business. And with that comes a high level of trust that you have with either and or both of those groups. With family members, obviously there's a high level of trust and intimacy of knowledge of the business and your level of comfort with them. And the same with employees to the degree that you're thinking about, if you're thinking about transitioning your business to an employee, that would be one that you have a high level of trust and confidence in. And in that employees category, I mean that both in the terms of a particular key employee or group of key employees on one end, or the entirety of your employee base, maybe through a more formal program like an ESOP, an employee stock ownership plan, where you're actually transitioning the business to the writ large, the entire employee base. So the positives there we touched on was that level of confidence and familiarity. The challenge with internal exit participants or potential partners is really twofold. One is they typically lack a wealth of proceeds of capital to be able to provide you a meaningful liquidity event at closing. Simply put, they don't have a lot of cash to pay you typically for your business at closing, which may or may not be important to you. But to the degree that you're thinking about this option, typically we see staged purchase prices over time, whether they be a seller note or some other type of phased-in approach that allows these internal audiences to transition into ownership and to transition capital to you for that ownership over a period of time rather than at cash at closing. And for the family members, the other consideration here is, if you're thinking about your son or daughter or niece or nephew or whoever you may be thinking about, is there a desire and an aptitude for them to take over the business after you want to exit? And, you really need both. They could have a desire, but not an aptitude. They could have the aptitude, but not the desire. And so neither of those things can you really influence. You really want to make sure that you're understanding if that is part of your exit planning scenario, that both of those things exist or will exist when the time comes. And I'll mention before we go to the next group that we don't advocate our clients picking one of these early on, but simply being aware of the whole waterfront of options here, so they can consider them. And there may be periods where one is more attractive than the other, and that may shift over time. But just understanding the entirety of your option set, we think, is important. So external options involve exiting your business to a third party. That's really where I spend my professional career, is helping our clients find external parties to acquire their business and to help facilitate their exit. And the two subcategories here are simply strategic buyers at one end of the spectrum and financial buyers on the other. Strategic buyers are companies, organizations that are either in your industry or perhaps in a tangential industry. And they have a growth strategy, a strategic plan that they are pursuing independent of you. And the question is, does what your company what your company brings to the table, the strategy path that you're on, does that fit with one of the strategies that company, that strategic buyer is pursuing? Are you a missing piece of a puzzle that they're trying to create? And if that's the case, they can be a very attractive and aggressive buyer for your company, because they're looking for acquisitions that can help bolt onto their organization and help take them where they want to go. On the other end of that external spectrum, we have financial buyers. And these are simply pools of capital, either raised from investors and groups like insurance companies and pension funds and endowments of colleges and universities, places that have excess capital to invest. And as part of their investment strategy, they have some capital in the public markets and some in the debt markets and some in the private equity bucket as an investment vehicle to make returns. Or it could be a family office where the capital is provided by one or more high net worth families who have decided to invest a piece of their net worth in this type of vehicle. In both cases, though, financial buyers don't have their own strategy to compare it to strategic buyers. They're evaluating the strategy of business owners that they meet and deciding whether their addition of capital and expertise might help further the business strategy that you as a business owner are pursuing. And so these are funds of capital that invest in private businesses and will at some point need to exit those investments to create a return for their investors, be it outside or family member investors to their group. And along the way, helping to build and create value for your business. And they can be excellent partners for you and your business and can provide that exit alternative. So as you think about the waterfront, we have internal and external. The pros and cons for external really relate to the inverse of the ones that we described for internal buyers. They typically do have capital, extensive capital, to be able to provide you a liquidity event, the cash at closing that you might desire. But there's not that level of familiarity and trust that you would typically see with the internal group. And so part of the process that we run with clients is really to create that level of trust as quickly and as deeply as we can over the 6 to 9 months that we're working together, so that we can have a good sense that our client's cultural fit and trust level matches that of the external party that they end up choosing. And so that's really important, in addition to the proceeds and the offer that a buyer might bring, is a alignment of vision about where the combined businesses will go after closing. So we can make up that trust deficit through the process, but it's not like your family or your employees that you maybe have known for decades. I'm seeing a note that we aren't seeing the slides, or at least Bruce isn't. Are we able to see them, Scott?
Yeah, I can see them fine.
Okay.
Is there anybody else having trouble?
We're going to try to sign in a different, again, separately. So just keep going. We'll figure it out.
All right.
Don't worry.
Thanks, Bruce.
All right, so to the question of sale readiness, achieving a sale ready posture. Really, when I say that, it involves these 3 topics, and we'll touch on each one briefly. And the first one, and perhaps the most novel of the 3 here, is establishing industry relationships. And so what I mean by this is raising your profile within the industry and starting to develop entry-level one-on-one connections with other larger players in your industry well before you need anything from them. And so this might look like researching the public companies in your industry, or particularly aggressive acquirers, consolidators in your industry, or private equity groups that have invested in companies in your industry. All that is easily found with Google searches. And then reaching out to the CFO of those businesses, or a corporate development person, and establishing a dialogue. And this does not involve conveying anything confidential or any type of trade secrets. Obviously, by nature of them being a good party for you to reach out to, there's probably by definition some competitive sensitivity to sharing anything too private or confidential, and that's not what we're proposing here. Really, the content of the discussions that I would propose you have is really no more than what might be found on your website. It's really more about establishing that rapport and kind of having them start to create a file, a virtual file, if you will, about you and your business. And it can involve things like asking them what led to their interest in their last couple companies they've acquired. You can find out information pretty easily through press releases and things about what those are and what they said the goals were, but understanding a little bit more about what they were looking for, and how those acquisitions have gone over time. Sharing a little bit about in general, who you are and what your strategy, again, at a very high non-confidential level is. And then if you follow up with those folks, a few quarters later or an annual basis, kind of checking in again and giving them a sense of, last year, this was the thing that we were thinking about doing in general, and we've accomplished that and we're moving on to this next thing. By the way, I saw you've done an acquisition since we talked last. How has that gone? And the benefits and the reason that we suggest this are twofold and very simple. The first one is you might pick up things from those conversations that would be valuable to influence your strategic direction for your business. So if you know that a particular buyer looks for XYZ characteristics or values these types of qualities about a business, to the degree that makes sense for where you want to take your business, why not create something that a buyer or more than one buyer is interested in looking for? I'm not suggesting that you take their advice and pivot in a completely different direction because one group said that's what they like to see, but to the degree that you see what buyers are looking for, that can only be beneficial to you to consider as you think about setting your own strategic goals. And then the second part is it starts to create that virtual file that I referenced, so that at one day in the future, when you might hire someone like me to help you sell your business, and that group or those groups are included in that process, and I call them and say, hey, I'm working with the XYZ company, helping them think through strategic alternatives, and we want to talk with you about a potential acquisition opportunity here. Instead of having a blank face and me having to explain from scratch who these people are and what this company is about, they can say, oh yeah, I'm so glad that you've called. I've really enjoyed getting to know them over the last X number of months, years, and I'm excited that we get to have an opportunity to look at this partnership chance with you. It starts us off at like at the halfway mark of the race rather than back at the starting blocks. So it can be really beneficial in a variety of ways, and I've seen this work very successfully. And the key is doing it well before you need something. Having those conversations and then saying, and by the way, my banker's going to be calling you about an acquisition, is less effective than having developed that rapport over time. Secondly is strategic planning. And so there is a wide variety of levels of complexity and depth to strategic planning. And I'm guessing that most, if not all of you, are doing some type of strategic planning now, and maybe feel guilty that you're not doing a more aggressive and detailed version of strategic planning in your business today. I'm not here to push any one particular plan or format, but simply to give you the suggestion that it would be helpful for a sale-ready posture to have some type of strategic planning that has three basic elements to it. And we'll touch on why. The first one is to create a written, high-level annual plan for what you want to accomplish in the next 12 months in your business. The second one is to track results against that plan over those ensuing 12 months so that you can have some type of measurement against the plan that you laid out. And then thirdly, and perhaps the one that sometimes is left behind, is to report those results, those actual versus planned results, to someone outside of your business circle or outside your business. That could be a spouse, that could be Scott, that could be an attorney, an accountant, someone in your social club or social situation. The goal is to have some audience that doesn't just know all this stuff and you're just sort of providing a high-level commentary to someone who was involved with how we got, what happened over the last 12 months, but you're presenting it to someone who needs to hear it from scratch. And the benefits here are twofold. One, I think this is good planning for your business in general and will help set your direction and give you a chance to track to that. But more importantly, for our purposes here today, is to set a track record of strategic planning and goal setting that we can then, when the time comes to exit your business, we can look back and create sort of a dialogue or a narrative about where your business has come and why. Your current strategic plan at the point of wanting to begin an exit process is the blueprint for what we will, for the materials that we will produce on your behalf to take to the market. it's I think a common fallacy that the materials that we use to sell businesses are predominantly backward looking, and that's just not the case. Buyers are buying the future, not the past. And so they're more interested in what you're going to do tomorrow and next year, the next 5 years, than what you did yesterday, last year, and the last 5 years. They do look at the history, the historical performance, to give them confidence at whether they believe what you're saying for the next future period. But ultimately, whether you had your best year last year or not is irrelevant to them. They want to know what you're going to be doing next year. And so that current strategic plan that you will have gained skills in producing by doing the previous annual plans will give us the roadmap for here are the things that the business is talking about doing. Here's what we're planning to do in the future over the next 12 months. And as a side, that practice of explaining your results to some third party will strengthen the way that we will have you talking to buyers. It allows you to practice talking about your business at a very high strategic level, not so much in the details day to day, and will also be a blueprint for how you will interact with your new partner during your transition period after closing. They typically don't want to micromanage your business. They want to hear at a high level on a monthly or quarterly basis how things are going and where you're headed next and how you're tracking against your plan. And so the strategic planning that I'm advocating will give you strength in those skill sets and make you better at them. The third plan here, the third suggestion is to have a succession plan. To the degree that you want to exit your business to maximize the value of your business at the point of exit, it needs to be as successful without you as it was with you. And that involves having some type of succession plan. The succession plan doesn't have to be complete. It doesn't have to, the business and the reins of your business don't have to be turned over to your successor for the transaction to be successful, but it needs to be at some point along that, there needs to be a succession plan and you need to be at some point along that, that phased in trajectory. So the closer you are to handing over the reins and the more responsibility that you've moved from your desk to someone else's desk, the better. But to have a plan in place is the most important thing. Having a business that relies too heavily on its owner and no succession plan of any kind in place is a very, very difficult business to sell. It's really a job. You have a job, not a business. And so without that, you are going to be stuck in your business for a long period of time and the values until you can make that succession plan happen post-closing, and the value for your business will be reduced because the buyers will see risk in having the entire business revolve around the owner who now has, you know, a lot of capital in their pocket and the entire business rests on them going forward. So those are really the three main areas that we advise our clients to think about, regardless of where you are in your time continuum for an exit, to be sale ready. And so if you have those things in motion, you're in a much better position to react to some of those triggers that we talked about earlier when an M&A process may arise. And the second question that I said that we would talk about is knowing about timing, when the time is right to sell. I probably get two questions most often from business owners when they hear that I'm an investment banker and I help business owners sell their business. The first one is timing, and the second one is value and how much their company is worth. And we're going to talk about that next. But for the moment, how would you know when the time is right? Obviously, no one has a crystal ball. It's very difficult to time the perfect point along your milestones for an exit. But the best way to answer this question, in my view, is to take a more pragmatic approach to evaluate these three areas and decide how attractive they are at any given time. And so the idea is that if these are neutral to positive, and the more positive, the better, the more you have that, the closer it is time to exit your business. So the first one is the M&A markets. Just like you would want to sell your house in an active real estate market, the same analogy holds true for M&A markets. So the good news here, this is the world that I live in, the M&A markets have been very hot, continue to be very hot. Even today, in the midst of a global pandemic, M&A activity continues. definitely saw a little bit of a pause in the early springtime, but quickly the forces that play in the M&A markets have adjusted, and M&A activity continues. That is not a mystery. It's really driven by an excess of capital chasing a limited finite number of good private businesses in which to invest. That capital is provided by those strategic buyers who need to make acquisitions to grow and to expand and to diversify and to keep the promises that they've made to their investors about growth. And those financial buyers that we talked about that have raised pools of capital that essentially have ticking clocks on them that they must be put to work or they are returned back to their investors. And so there's a lot of capital that's been raised based on the success of investing in private businesses over the last 2 decades or more, chasing a finite number of good, high quality, middle market, private companies that are interested in selling. And so that supply demand imbalance, fueled by historically low rates of interest on debt, which helps facilitate acquisitions, means that it's a seller's market, and it will be for the foreseeable future. There are certainly things that can impact that. Major changes in tax and capital gains taxes in your home country or area can impact that. Certainly the great recession of 2008 and 9 which was driven by financial market instability, retracted M&A activity, but in general, you're going to see a continued strength in the M&A markets. That's the good news there. That almost by default gets a check mark. So then we go to your industry and your company. And the reason that industry is next is it's more important than company. So it is harder to sell an A+ company in an out of favor industry than it is to sell a C company in an in favor industry. The industry trumps the company. And the reason for that is the industry itself, are those powers that are influencing the industry that include you and all of your peer companies in that sector, are those forces beneficial or maleficent? Are they helping or hurting? Is this a good space in which to invest broadly before we get to your company or not? The classic example here that may be easy to understand is the oil and gas industry, at least in the US. If oil prices are high, any kind of company that can say it helps support the oil and gas supply chain, the value for those businesses goes up. When oil prices fall, you can't give away an oil field services company because no one wants to put capital into a depressed industry. So looking at your industry and what you see coming down the pike is really important. Are there going to be some major disruptors over the next horizon during which you might be considering an exit that are going to either positively or negatively impact your industry? That's something to really pay attention to and to focus on. Obviously, you do that for your own business and how you'll navigate those waters of what you see coming ahead, whether it be regulatory or competitive threats from other geographies or other adjacent industry. All of those things that you're evaluate them for not only where you're going to take your business through those industry forces, but also how attractive or not those industry forces might seem to a third party looking into your industry to invest. Positive to check mark there is important for an exit timing process. And the last one is your company. And the easy thing to think about here is, for anyone who follows baseball at all, we want to exit in the 7th inning of the game. We don't want to wait until the bottom of the 9th, or we're in extra innings, or the lights have been closed and the teams are going back to the buses. We want to be selling your business when there is great historical trends, but some great positive trends ahead. Those last innings in that baseball analogy. It really goes back to the point I made earlier about buyers investing in the future, not the past. And this is the one that I see business owners making the mistake more often than not, is waiting too long, waiting until the business has peaked or plateaued, and then thinking about maybe now is the right time to sell. you can see where a buyer would be less aggressive in valuing a business that's plateaued or has started to decline versus one that is still on the upward trajectory. So thinking about making sure there's some gas left in the tank for the next owner is really important in driving value for your business when the time comes to exit. So speaking about value and maximizing price, let's talk a little bit about valuation of private businesses. They are tricky. Unlike public companies where at every minute of every day you can check the market cap of Apple or Google or your favorite publicly traded company, and it will give you a precise number for the market cap of that company, and that's that day's essentially market valuation for that entire entity, or at least the equity piece of it. That doesn't exist for private business owners, unfortunately. And so enter business valuation providers, and we have an arm that provides business valuations as well. And from a theoretical perspective, there is a science to private company valuations. This involves some valuation methodologies and models that we use that compare your business and its future, projected cash flows to other publicly traded companies where there is an established market value, to transactions that have occurred in your industry and making comparables there, kind of like you would look at comparable home sales to get a value for your home. We do some theoretical modeling around discount and cash flow analysis, harkening back to your Finance 101 days. And all that mixed together can give us a theoretical valuation for your business. And that's essentially what a business valuation report would do that you might commission. Those can be helpful if you need a pinpoint valuation for some specific reason, like partner buy-in, partner buyout, gifting shares of your private company to someone, be it family member or otherwise, settling up an estate, those types of things. But in terms of selling your business, that's only one piece of the puzzle. The second piece of the puzzle is the art of the M&A process. And that's really where investment bankers like me earn our living, is taking the theoretical valuation that the models might give us and give the entire buyer community, but then using that as a baseline to run a process to find those buyers that see special value in your company. And the more special they see your business and how it fits into what they're trying to do, be it those strategic buyers that have a strategy that they're trying to pursue, or those financial buyers that are trying to invest in certain kinds of businesses and back certain kinds of management teams, those are where we go above the theoretical value to find that elusive spike bid. If we were to run a process, and we do this all the time for your business, and get first round bids for how much buyers value your company based on the exact same information that's distributed to each of them, we would see a distribution like a normal bell curve. And you would find some people at the low end that are tire kicker value buyers who are trying to get a steal. They're very low. You would see the bulk of the market in this sort of scientific theoretical value range that actually there's a cluster where you can see they're all basically running the same models with the same inputs and finding similar valuations for your business. And then you would see the upper tail of this distribution where there's something special about your business that has found that these buyers see that is over and above the rest of the market. Those are the groups of buyers that we focus in on after that first round, and continue to push them to find those groups that ultimately at the end of the day, you need the one or two buyers in the market that see more value in your business than the 95% of the market that was in that middle to lower part of the bell curve. You just need one ultimately to sell your business to. And so that's where the valuations get tricky, because they really are in the eye of the beholder. And so there's a lot of opportunity to influence that perception of your business and to create value for your business at exit by running a process and how you present the opportunity, which we'll talk about next. Hopefully that all makes sense. Going back to our Finance 101 formula for the discounted cash flow model, we're not going to get into modeling today. Happy to talk with you about that in detail offline. But at its very core, to value an investment of any kind, you have two pieces to the puzzle. One is the absolute dollar amount of the cash flow that your investment or your company generates. And then secondly, you have the perceived risk of those cash flows. And the discounted cash flow model discounts those cash flows back based on those perceived risk. So to increase your value, we can do two things. We can increase the nominal value of your cash flow, actually grow the bottom line of your business, which you're all focused on doing, I'm sure. And it's the margin that we're trying to grow, not just the top line. So growing top line for top line's sake at diminishing margin levels is not as valuable as slower revenue growth with more margin growth. But the second piece that's maybe easier to focus on in the near term is reducing perceived risk. Because if you can reduce perceived risk on the same projected cash flow, you will increase value. And I say perceived risk because these are things that outside parties might perceive as risky about your business that perhaps you don't put the same level of risk onto that they might. And so really putting yourself in the shoes of an outside buyer, looking at your business. What are the strengths? What are the things that they would like about your business? But where are the areas of weakness or perceived risk? And then finding ways to mitigate that risk for the benefit of those outside viewers. And so this is where, this is the root for where we see advice like recurring revenue is more valuable than one-time revenue, project revenue. It's because it sees as perceived less risk. Diversified customer base versus having a high level of customer concentration. Again, perceived less risk. Depth of management team, geographic diversity, strong IP protections, if that's applicable to your industry. All these things reduce risk and therefore increase the value for your business. So I don't want to harp on this too much. There'll be some specific examples of this in the follow-on one pager that I send you. But thinking about where are some perceived risk areas in your business and your ability to reduce those can help increase the value of your business immediately. So with all that said, I wanted to take a step back, maybe increase the levity a bit and talk about, I'm no Dave Letterman, but talk about the top 10 M&A mistakes that I've seen in my career made and highlight them for you now so that you can avoid them. So number one is one that we've talked about already, and that is waiting too long to exit. And again, I'll have these in the one-page handout. I think a point to remember here that is valuable is that an exit is not the end of the line and something to be delayed until the last possible minute. And another way to look at it is it's a way to create new chapters for not only you and your family with the capital that you would provide, that you would receive from selling your business, that you can go on to do other business ventures or philanthropic things, or to set up your children or grandchildren's college, all the things that we want to do with those proceeds, start a new business, buy a new business, other things. But it also opens up new chapters, creates new chapters for your company and for your employees. So your company will continue on with the new partner, and if you've chosen a good partner, it will do wonderful things in its next chapter of its evolution. And we see businesses all over around us today that you can see market changes or kind of milestones in which they created new chapters as they grew and expanded over time. And many times those are correlated to new investments in the business or changes of ownership in those businesses. And then lastly, for the employees, and this is what I see all the time, is that selling your business can open up new opportunities and career areas for key employees in your business. I had a client that we worked with recently who had a key employee who he was deathly afraid of losing. But he kept giving her more and more responsibility, and there was no more responsibility to give. And she had mastered every challenge that he had given her, and he was sort of running out of challenges to give and was worried that she would leave. Well, I helped him sell his business to a larger family-owned enterprise that now has multiple levels of continued career progression for that key employee. And in fact, they now are working at the parent level, taking on a larger role than was even available in the company before. So as you think about the timing, and we talked about some of the things to look for, keep in mind that the exit, your exit, is not the end of the line. It's merely a waypoint, a new chapter beginning for not only you and your employees, but you and your family, but your employees and your company as well. Number two is that one that we've already covered, and that's the lack of succession planning. And so I won't belabor that, but having a plan in place is really, really important. Buyers don't want to buy a business that's leaderless, and they're looking to the future. So making sure that they have someone that they know will continue to run the business. Even a strategic buyer is going to want some level of executive management at your company going forward. It's a little bit of a myth to think that strategic buyers are going to assimilate the business and they don't care about executive leadership. They're going to want someone who's going to be charged with growing this business inside of their corporate hierarchy to make their purchase price a successful investment for them. Number three here is poor positioning. And this involves the idea that you, through an M&A process, have the ability to position your company as broadly or as narrowly as you see fit. And oftentimes buyers make this mistake of defining their company too narrowly. And the reason that's important is because it directly correlates to how much growth opportunity is ahead of your company. And so, you know, a classic example that that for those of you who are familiar with Capital One, which is a public company actually headquartered just up the road here from me in Richmond, Virginia. Very large financial institution and credit card company, one of the largest credit card issuers in the US. They describe themselves, I don't know currently, but very recently, not as a credit card company, but as an information-based marketing company. Very different. And the idea is that what they're really good at is not issuing credit cards or now running retail banking locations or the other lines of business they've gotten into. But what they're really good is taking data analytics and using it to create really successful marketing campaigns based on information and data that have high success rates in the marketplace. And they choose credit cards and now retail banking and other things as the vehicles by which they grow their business. But at the root of it, they're an information-based marketing company. So you can see that if someone was looking to invest or to buy Capital One, they'd be much more excited about a growth engine that has lots of different avenues for growth, credit cards being one of them, than saying, well, we're just a credit card company, that's what we do or who we are. So thinking about your business more broadly, how you position your business. Are you a manufacturer of pencils, or are you a creator of writing and instruments for artists to communicate their vision to the world? Opens up more opportunities, which directly relates to more value. The only limiter to this is it believable? Can you make an intellectually honest case for supporting that vision, that positioning that you've created? But I would encourage you not to think too narrowly when you're describing what your business is and what potential opportunities for growth lay ahead of it. The fourth one is lack of preparation. This involves sort of housekeeping in both the literal and figural sense. If you are a manufacturing facility or have a plant floor or distribution facility, this might mean literally getting your facilities cleaned up and in good working order, repairing things that need to be repaired. But it also relates to making sure your documentation is in order, making sure that your customer contracts or relationships are well documented, and that you're not working off handshake agreements. The same with vendor relationships. Your corporate documents are in line. These are all things that in an M&A process, we're going to need to draw upon and to show buyers the documentation and to give them tours of your facility. And so having those be in tip-top shape and all the I's dotted and T's crossed ahead of time will allow us to focus you and our efforts on more value-creating exercises like convincing them about the positioning statement we just talked about, rather than tracking down an unsigned lease for a warehouse that you have somewhere that never got the execution copy filed. So thinking about some of that good housekeeping, both physically and in the paper form, well ahead of an exit is a mistake to avoid. The fifth one here is prejudging buyers. looking here to the beginning of a process to not exclude buyers based on your perceptions or their reputations in the market. You certainly ultimately have the ability to decide who you want to contact in a process or not, but keeping an open mind at the beginning of the process and not excluding someone ultimately can help benefit you later in the process by having a group in the process that maybe surprises you to the positive that you would never have realized if you hadn't included them to begin with. Sixth is avoiding mistakes, avoiding surprises to the degree that you can. And the reason I have the handcuffs here is the quick story of I was selling a very well-run business from one private equity group to another. I got a call 2 weeks before closing that I hope I never get again, which is the buyer had performed background checks on our management team and asked me, did I know that our head of sales was a convicted felon and had spent time in prison in the 80s for cocaine distribution. I did not know that. That was an avoidable mistake that completely derailed the process unnecessarily, despite the fact that that individual had signed a consent to having a background check run. So it wasn't a surprise that this was happening. Getting ahead of things like that, getting ahead of something that you think will cause issues or concerns for buyers before they discover them themselves is a great advice to give and a mistake to avoid. So getting ahead of those things before they become an issue for the buyer will save you a lot of headache and to keep your deal on track moving forward. Seventh is an overfocus, an overemphasis on price. Obviously, the reason you sell your company is for the purchase price, but we encourage our clients, and they often do look at a variety of other factors, not just the top bidder, when choosing their ultimate final winner of the process and buyer for their business. And so things like culture fit, alignment of goals for your role post-transaction, how the employees will react, how the market will react. These are all things that I've seen have caused a client choose to pick maybe the second highest bidder rather than the top one as being the perfect partner for them, not just focusing on price. 8 is the lack of strategic planning. I think we've talked about that one. 9 is a lack of negotiating leverage. So this is where having a representative, an investment banker on your side, helping to keep the buyer honest and provide negotiating leverage is really, really important. It's hard for you to do that if you are representing yourself and there are no other buyers or no process being run, and the one group that you're talking to knows that they're the only game in town. And you don't know if you're talking to one group, going back to that bell curve distribution we talked about, whether you're talking to a spike bidder or a value buyer or someone in the middle, because you have no points of reference. And so I encourage you to have representation. We'll touch on it very briefly at the end, but our fees are more than made up for by the value that we bring to a process, often economically. So we can often exert more incremental purchase price than our fee would be. So it actually ends up costing little if nothing to have our advice. And the ability to have negotiating leverage is critically important through the sale process. And last one is overly complex deal structure. Sometimes that attorneys and investment bankers and buyer and seller can get way too complicated in structuring a transaction than need be. And if you can't describe what you're selling and what you're getting for it to a middle schooler, not using the numbers, but just at that basic level, then you may be in a transaction that's more complex than need be. And the risk here is that it becomes so complex, the deal falls apart because either buyer or seller or both lose focus on what we're really trying to achieve and get so bogged down in the details that fatigue sets in and the parties part ways without completing a transaction. The last section here, and I will go through this exceptionally quickly so that we can make sure we have time for questions, which I do want to get to, is just to shine a little bit of light into the M&A process so that it doesn't feel like some big dark cloud that you don't understand what it involves and how it unfolds. So very briefly, an M&A process, when you decide to sell your business, an investment banker like me, and this is pretty much universal, will run a process that involves 3 phases. Each of those phases takes about 2 to 3 months, and you want it to make sure you go through them, methodically. The first one involves preparing the materials about your business and researching what buyers you want the group to contact on your behalf that will achieve the goals that you want to have for the process. The second one involves your representative using those materials to contact those groups that have been identified and approved by you. They sign a non-disclosure agreement before they get any materials. And basically an auction process is run where they submit first round bids based on that information. You pick the top groups that you want to move on to the next round, which involves one-on-one conversations and meetings with those top buyers, more than one. Two-way marketing, two-way interview process at that point where you're understanding their strategy and getting to know them. They're doing the same for you. Ultimately, those groups put in a final bid called a letter of intent, and you can negotiate amongst those and pick an ultimate winner. And then the third phase is essentially you've picked your buyer and now we need to get through to closing. And there's two basic categories there. One is the due diligence, sort of the inspection in detail of your business that involves outside accountants and attorneys and risk providers, insurance companies, really understanding the depths of your business. And that's where all that documentation being buttoned down is important. And then the legal negotiations of the purchase and sale agreement, the document that will actually describe what's being sold and what responsibilities both parties have to it, is negotiated. And each of those processes, again, phases take about 2 to 3 months. So you're looking at a 6 to 9 month process to do it well. And this is obviously not something that you want to rush through and cut corners. The types of process that you can run vary from talking to one buyer exclusively to talking to 100 or more buyers in a broad process. And we counsel our clients to create a custom process that fits their goals. The trade-offs, which you might imagine involve level of confidentiality, from easy to keep it very close and under wraps with one buyer, more difficult with 100 plus buyers. But I think we do a good job, but it's more likely that leaks might get out there. Speed, it's quicker to deal with one buyer than to go to 100 buyers. But the offset here is certainty of maximizing price and maximizing your overall outcome. It's very hard to know that you've done that with one buyer. It's very easy to feel like you've uncovered the best possible deal out there if you talk to more than 100 buyers. But some of the trade-offs there typically focus our clients on that targeted middle range where we work to find, 10, 20, 30, maybe more of the best potential buyers and sort of get the best of both ends of the spectrum through a targeted process. And the very last slide is people often wonder how we get paid, and rather than have that be a big question mark, I decided we should include a slide about it and be transparent. So this is a universal fee arrangement that all investment bankers use. It's largely driven by a success fee that's only due at the closing of a transaction, and it typically is tied to the value of that transaction. So the more purchase price we get for you, just like your real estate agent getting you a higher price for your house, the higher the fee. And that's the way you want it. You want us incentivized to maximize price. We don't charge hourly rates. We're not billing by the hour. The only thing that we have at the beginning of an engagement is a retainer. That retainer is typically a fraction, 10% or so of the eventual success fee. And that really makes sure that we are all aligned and focused on moving forward and committing the resources from both sides to make this a successful transaction. And that's the only fee that we receive outside of the success fee, but it's the only one that is sort of guaranteed. We're not in the business of collecting a bunch of retainer fees and not having successful transactions close. And so it really is a sign of commitment that we're going to be working together. And typically those retainers are credited against the success fee at closing. So with that, I will leave it on this slide and open it up for questions. I really appreciate your time. I know we covered a lot of material. There's more information in the book. I'll have this follow-up one-pager that I mentioned. I will email to you that you can have on hand, and we'll have some details that we talked about. And I'm happy to offer a 30-minute confidential discussion with you at your convenience about really any topic that we talked about, or if you want me to opine on something more specific to your company than you'd like to cover in this group setting, I'd be happy to do that with no obligation or strings attached. Just shoot me an email there at my contact information. So with that, Scott, I'll turn it back over to questions.
Terrific. Thank you, Jonathan. Good stuff. Well presented. My head hurts a little bit, but as you said, a lot of this stuff is in the book, and one of the biggest questions that comes up. Let me get to that in a minute. But one of the questions that has been asked in the chat here has to do with valuation, and the question is could there be unconscious bias in the determination of evaluation? And I'm going to presume that the answer is yes, and add to the question what I would think is how do you get around unconscious bias in putting together evaluation?
Maybe I'll mention one thing and see if this answers the question, because I think I probably skipped an important step, and that is at the beginning of a process when we're talking with a potential client, we will do that science, the theoretical valuation piece, to make sure that we are on the same page, that if we think your business is worth $20 million based on our analysis, you say, yes, I'm comfortable that I'd take a $20 million deal, and I don't think my company is worth $100 million. If that's the case, then we're probably not a good fit for you. So we use that to basically give that middle of the bell curve. Here is a valuation we have a high degree of confidence in achieving through a process based on our modeling. If we're on the same page and we decide to move forward, though, that whole analysis is set aside. We don't put listing prices on our businesses. We basically have that process run to determine the value and have buyers give us their valuation. It's that value's in the eye of the beholder, and they'll try to ask us, what have you told them about valuation? What are they expecting? What do you think this thing will trade for? And my response over 20 plus years has been consistently, we're going to the market to see what where the value lies there, and we'll react to that. I feel comfortable that we're ready to sell at a market-based price, but we're going to see what the market says this company is worth. And so to some degree, I put that back on them. Does that answer the question? We're not setting list prices and then therefore trying to influence the market.
Yeah, I think it's like any real estate agent will tell you that the value of your house is what somebody is willing to pay for it, and it's the same. It's the same here. And yeah, there's going to be all kinds of factors, conscious and unconscious, in that deal. Your answer kind of leads into the next question, which is which I see a lot. People say, "Well, I already know who's going to buy my company," and I don't see why I need to pay an investment banker to do a deal that I can do myself.
Yep.
You have an eloquent story in your book about that. Could you elaborate on that a little bit?
Absolutely. There are a number of reasons why that you might want to, and you should use an investment banker, despite the fact that you have a strong degree of confidence in who the ultimate buyer is. And there's probably two different ways we can go with this, Scott. One is the actual identity of the buyer. If I had to say over the dozens of deals that I've done, maybe 10% of the time, maybe, the ultimate buyer was predicted. 90% of the time, our clients nor us can say with any degree of certainty, or 90% of the time we're incorrect in guessing who the ultimate buyer is. And it's because we just don't know, and frankly, you don't know what's going on in the boardrooms of those companies at any given time. And they may have been courting you for years, and when you're finally ready, they're having some other internal commotion, they're focusing in a different area, their stock got hammered last week and they're not making any acquisitions. All kinds of things have to fall in line for a successful transaction to occur. And to have a focus on one buyer as the known buyer and the predicted buyer is going against the odds. It's not likely. So that's part of it. But secondly, to the degree that you've got a buyer at the table, and so that would indicate that maybe they are ready and you do now have a higher degree of confidence that this is the buyer and they've made an offer to you, there is still significant value that we bring. That's really the exclusive negotiating end of the process that I mentioned. And we provide negotiating leverage to keep that buyer honest. There's still 3 months of work from signing a letter of intent with a buyer at a given price before that money actually hits your account. And there is a lot of discovery and a lot of potential issues that can arise in even the cleanest run businesses that can influence or affect price. Your price that you sign with a buyer at a letter of intent will never go up. They will not find things that are better than they thought and say, you know what, we think we should pay 10% more because of what XYZ things we found, but they will absolutely be looking for things to drive the price down. And so at that point, we're playing defense. You'd be playing defense on that price and trying to avoid price reductions. And that's really hard to do without an investment banker or an advisor to you. And the second piece of that is setting even aside price. And I'll mention on that point, you know, we have gotten involved. I closed a transaction in June where the ultimate buyer was at the table before we got involved. But our client, before they signed anything, got us involved, and we were able to negotiate an extra $2 million of price with that buyer that ultimately we closed on. And obviously our fee was not $2 million. And so the ability to have an investment banker involved, that threat of going to other buyers, whether you actually do it or not, that we represent, in addition to the market knowledge and the ability to hold them honest, keep them honest, when they ask for out-of-market terms that maybe don't relate to price, but relate to your risk about the business going forward. All those things are significant value creators for you. That's really hard to do when you're negotiating without representation. So hopefully that answers the question in a couple different ways.
Okay, thank you. A couple of other questions. Maybe you want to ask them directly. Bruce,
So
maybe you want to ask that?
About range of deal size that we work on. We work on companies, so that's a simple question, typically with 50 million in revenue and below. And we have a business broker arm that works with very small companies, like Main Street companies that might be worth $1 million or $2. I typically work with companies that trade for $5 to $50 million is sort of the sweet spot that I work in. Few years away from selling the company, and the question here is about, at this stage, things like profit sharing and slices of equity to employees to take on more responsibility. Great question, and I applaud you for thinking about it proactively. My advice here is in a couple different areas. One is equity in your company is super valuable. I know that goes without saying, but make sure if you plan to use it as an incentive to key employees, they value it the same way. I have seen where equity was essentially wasted on an employee because they would have been just as happy to have a $100,000 bonus than 1% of a company. Recognizing that 1% would probably be worth more than the 100,000 at an upcoming exit. But if they don't value and you're not getting the renewed commitment or the excitement or the ability to grow your company commensurate with the true value of that equity as you see it, I would encourage you to do something else. Have some other kind of incentive plan that's more cash driven, or maybe even some type of phantom stock plan where you don't have actual partners, but you reward them for value that they've created from this day to a future exit event, rather than doing actual stock. So working with an investment banker as well as an attorney can craft plans that make sure that you get the desired outcome. And I'm a huge proponent of incentivizing key employees to help create value for you and for them. So I'm not against this, but making sure that it's used appropriately and not misused is something I do see a lot, and you want to be really careful about that.
Okay. John has a question about discounted cash flow valuations. John, do you want to ask the question?
Sure. Hello. So a discounted cash flow model uses forward projections, right? Maybe 10 years
yes.
of revenue projection. And I don't know about anybody else, but I cannot predict next year's revenue, or let alone the year after that. But 10-year, I mean, sounds unrealistic. So is there any meaning in that? And also a discounted cash flow has a discount factor, which has a risk element in it. So that's the risk-free rate plus the risk factor, and that feels a bit arbitrary as well. So in general, I've been a bit critical of that approach, but I'd be very interested to hear your thoughts on that.
I'm 100% in agreement with you, John. I'm critical of the DCF model as well for the reasons that you just gave. It is highly influenced by the revenue growth, the margin assumptions, and the discount rate. So I don't spend a lot of time focused on any of those science methodologies. I talk about them because if you needed a theoretical valuation, a DCF would probably be part of that, a discounted cash flow model. And the best that you can do is to make sure that there are reasonable assumptions that are put into it. But it's highly subjective for all the reasons that you just mentioned. And I spend little time in that area. I think it's good to run to see what buyers might be getting back from their running of that model. So sometimes we will run a DCF model based on what we think a particular buyer's assumptions might be, using a risk rate that reflects how they think about their cost of capital and their weighted average cost of capital, to try to get a sense of what their models that they're running are telling them about our company. But ultimately, my focus is the art side of going out, presenting the best opportunity that this company can possibly present, and letting the market determine the value. There are things that drive value, meaningful changes in value that you would not believe, and I don't mean that personally, but just it blows my mind. As a quick example of that, as to how far actual valuations deviate from DCFs and theoretical valuations. I literally sold a company where a private equity group who was in the final runnings, and we were negotiating with them and 2 other buyers, told us confidentially that that group had not made any acquisitions that calendar year. This was like in October. And this was the last chance for them to get a deal closed that calendar year. And they would pay whatever it took to win this deal, rather than go back to their investors and say they had made no acquisitions in that calendar year. And they outbid everyone else by like 15%. It was easily several $1 million worth of value to avoid embarrassment, internal embarrassment to their investors, and the ramifications thereof. And so there was no DCF in the world that justified the value that they paid. It was pure self-preservation.
Those guys still looking for something?
Yeah, exactly. Unfortunately, they've gotten a little bit, they've had a better year, so we can't use that again this year.
Sorry, John.
Thank you.
Absolutely.
Other questions?
Can I ask another one?
Yeah, go ahead.
So I've heard that big strategic companies, technology like Amazon and Microsoft and the rest of them, look at the technology, and if they like it, a kind of a standard approach is 10 times sales. Is there any merit to this, or I'm just smoking dope?
No, so I'm always hesitant to fixate on a particular number multiple. So let me start with the concept of going from an earnings multiple to a sales multiple, or revenue multiple. That absolutely is more likely in the technology sector than any other. Most businesses outside of technology and maybe financial institutions and some specialty industries trade on a multiple of earnings, because ultimately it's the cash flow from whatever business that's going to be driving the value that that a buyer would see in it. Technology is one of the exceptions, and they do typically trade on a sales multiple versus earnings. Now, to your point about 10 times, whether it's 8 times or 10 times or 6 times, revenue multiples can create very high valuations very quickly versus earnings multiples, which for a technology company may be very small or non-existent. A differentiator, and I think you mentioned this in one of your earlier questions that you posed, is recurring revenue, monthly recurring revenue, annual recurring revenue, versus total revenue, which would include one-off costs like project-specific costs of onboarding or making some major changes to a technology for a particular client. And maybe even going down further, licensing, where you have a periodic license fee every 2 or 3 years versus a pure SaaS model where you're having monthly recurring revenue and you get away from those big chunks and spikes of revenue. All that is seen as more valuable. And we do see technology companies trading on a high multiple of recurring revenue, perhaps even 10 times, and then some lower multiple on that non-recurring revenue to get to sort of a blended that probably is less than 10 times total, but does clearly value recurring revenue more highly than non-recurring.
Okay, thanks.
Absolutely.
Anything else? I have one, and that is that, you know, I've seen companies sell and in the negotiation, look at the valuation that the buyer would have. And so they would say, but if you had us, you could have a multiplicative effect on your revenue because we can, you know, we can do something that you can't do, or we can facilitate more sales of your native product, your existing product. And the buyer says, yeah, that may be so, but that's what value we bring to the table, not you. So how do you argue against that?
Yeah. Great question. We see that all the time. And so those are generically called synergies, and they can be cost-saving synergies, which are less positive to think about. The more exciting ones are the revenue-enhancing synergies, like you talked about. So if we combine our business with your business, you'll be able to sell more things to more people and create revenue synergies. And the short answer to your question, Scott, is there is an intellectual argument on both sides of that in reality, those synergies don't exist with both parties coming together. They don't have them without you, and you don't have them without them. And so I use that as an argument for sharing those. So we would say that, yes, you're a right buyer, and you shouldn't pay us 100% of those, but you should definitely factor them in, because we're happy to sell to someone else who's looking at it differently and not giving us any credit for those. And it makes no sense for you to lose a deal over giving us 0% credit for those. So some type of sharing, I think, can work and still be a win-win for both sides. But saying that because they are a party to bringing those to bear, we should get no benefit from them is a weak argument to defend.
I also see when people establish a price in a letter of intent.
Yep.
As you pointed out, that number never goes up. And just to be clear, that's a sort of an opening bid, right? And then they go into due diligence, and I've seen companies just shred that valuation in due diligence. And that's their modus operandi. I can think of a couple of companies in particular that'll go out with a big letter of intent number and then just take the stuffing out. And by then you're committed to the process and you really feel like you don't have a choice. Yep. Can you talk about that situation a little bit and what you might do to prevent that?
Absolutely. And I mean, that dynamic exists with every transaction to some degree. So part of it is trying to suss out bad actors beforehand, to your point that some buyers get the reputation that their letters of intent are worthless. They're simply meant to lock up the deal, that they're gonna retrade the deal later. And to some degree, you can almost see it coming. And so having an investment banker who has worked with companies in your industry and sort of knows which groups have developed your reputation for that or not can be very valuable. So try to avoid those groups to begin with. And so if they were your top bidder, that might be a reason to go with number 2, because you really don't think that top bid you have a high degree of confidence in it. Secondly, it goes to the strategy of what information to share before the letter of intent. So getting all your skeletons out of the closet before a letter of intent, and I'm not saying in the first version of the book, and on your first date, you're not sharing all of your your personality quirks, but before you get married, you probably have shared quite a bit of those. And so the same thing is true here. There is a point in time as the process evolves where you want to start getting out those surprise things that might be seen as surprises, taking away potential ammunition for purchase price reductions after the letter of intent beforehand, while you have multiple buyers competing. So telling them all about the bad environmental testing report you got last week before you have committed to one buyer allows them to react differently to it. And having one group overreact just means that the other groups are where you're going to focus your time. So getting those things out ahead of time as best you can is the second point. Even so, they will be doing a level of diligence and with a perspective that you don't have. And so there are always going to be opportunities for them to come up with reasons to want to try to retrade the deal. And to some degree, even their third-party advisors, like accounting firms that will do a quality of earnings report, which is basically an in-depth audit to justify to the buyer that the earnings are of a high quality. They often will say, we will find enough issues to pay for our report. And they're financially motivated or reputationally motivated to come up with something. Even if you've had audit by a big four firm forever, accountants can find gray areas and areas of differentiation. The best way to defend against all those things, having picked a buyer that has a better reputation and gotten as much of your issues out on the table while you have competition, is to have the ability to pivot and to say, if you don't like, we're not going to reduce the price. And if you won't move forward at the price you agreed to, buyers B and C are waiting for the phone call. It's up to you. And so, my negotiating style is not to yell and scream and to hang up the phone. It's to have options and simply say, we're happy to close at what we agreed to. We're happy to move forward. It's going to take us a little bit of time to pick back up with group B. So we prefer not to do that, but we have other options. If you don't have other buyers, your only lever is, well, we're just not going to sell to you. And that's legitimate, and no one can force you to sell to anyone. But if you're dealing with one of those triggers, you kind of may have your back against the wall, and to restart a process and to find a whole new buyer may be so unattractive that you might be forced to take a lower price. So all those things are things to guard against, but you're absolutely right, Scott. There's that potential dynamic exists in every transaction.
Okay. Victoria has her hand up.
Yes, hi. Thanks, Scott, for putting this together. And Jonathan, thanks for a very informative presentation. So my question is about these emails that I get on a regular basis,
Yes.
From, and some of them are very creative. Some of them say, "Dear Wayne," and, so, I mean, if I'm not on the market, with my company, what do I do with those?
Great question. It used to be a file folder of pieces of paper that my clients would hand me when we sell and say, here are all these random letters that I've gotten over the time. Now it's all virtual and emails. I think a couple things. One, take it as flattery that you're on someone's radar screen and that they would like to engage with you. If they seem credible, save them in a folder somewhere for future reference. I think so. Typically, we would get kind of handed those at the beginning of a process to say, here, people have reached out to us over time. You may want to make sure that if they're legitimate, they're included in the process. What if we end up tracking down those groups, as you might expect, a small fraction of them are actually legitimately interested in your business and even know what you do. But there could be a jewel or two in those that you want to save and capture. But otherwise, I wouldn't spend a lot of time in them and focus on them. But just save them. I'm happy to follow. Whoever you hire would be happy to follow up with them and see. A lot of times they are brokers who don't really have a buyer, but they're trying to get you on the hook, and then they'll find a buyer and try to match make without having someone that they're really representing. But the last thing I'll mention on this one is, if it's a legitimate inbound inquiry from a known, good partner in your industry, that could be the opportunity to start that dialogue I mentioned at the very beginning about an industry relationship and say, look, clearly I'm not interested in selling right now, but I'm intrigued at your interest, and maybe one day I would be. Tell me a little bit more about what you're looking. I would only do that if it's a group that you really know, you think they'd be a good partner for you in the future. You could use that as a door opening to that conversation. Otherwise, stick them in a folder, and there's probably not a lot of opportunity in that in reality.
That's great. Thank you so much.
Absolutely.
All right, I think that's about our time. I will go back to the beginning of Jonathan's comments and say that I know there's a lot of money out there. There's a lot of activity out there. I've been kind of surprised. 3 of our 45 member companies have sold in the last month at very good multiples. So it's not a bad time from that point of view to at least be thinking about it. And if you are thinking about it, I'm sure Jonathan would be happy to hear from you to talk a little more about it. So thank you, Jonathan. The book is $100 Million Exit, and it's very readable and applicable to what we've talked about today. And I would recommend it to you. And if you have any questions for Jonathan, I'm sure he'll take them offline later, or you can route them through me.
Sounds great. Again, Scott, thank you so much for the invitation. It was great to be with you all this afternoon.
Thanks, Jonathan. Thanks, Scott.
Have a great weekend.
Excellent session. Thank you.
Take care.
Thank you so much.
You're welcome.
Informative. Thank you.
You're welcome. Thank you.
Hey, Jonathan, ever work with law firms?
I don't, I mean, I work with them. I don't think I've sold one, but we've done a number of professional services firms that would be comparable.
Yeah, cool.
Yeah.
Good to know.
Good.
I'm going to reach out to you on LinkedIn as well.
Oh, yes, please do.
Okay. Thanks again, Scott.
Okay. Thank you, Eric. Barb, you there? Guess not. Jonathan, that went extremely well. Thank you, and thank you for the questions, and I really do mean what I say about the book. So,
You didn't want to talk to me, right? You didn't even want to talk to me, right?
hi, Barb.
There she is.
Hi. Thanks for this.
Thank
You're
you.
welcome.
You know how to find
You're
me.
here.
Read this. Not ready yet, but one day.
Sounds
All right.
good.
Well, the time to start is now, right? It's
I just started a new business. I can't start yet.
oh,
I
good.
started an add-on to Cambridge Scientific, which is just going extremely well, extremely fast. So I got to take care of this yet.
Good.
Congratulations.
No, thank you.
I'll look forward to hearing about that when you can.
Yeah, whenever you're ready. Just give it
All
a
right.
shot.
All right, we'll give you a
exciting.
call.
Okay, sounds good. Bye.
Thanks, Barb.
Bye.
Bye-bye.
Yep, let's go. How do I get out of there? Here, help me out. This is the way you can see me. Now you can see what I look like.
There
That's
you
better.
are.
Yeah,
Have a
thank
good
you.
weekend.
I just was busy with my kid who's homeschooling, so I didn't want to putzing around the kitchen and whatever have you. Anyway,
Yeah.
nice to meet you.
Nice to meet you. Take care.
Yeah, bye.
I'll reach out. Thanks, Barb.
Okay.
There we go. Scott, thank you so much for having me. I really appreciate it. Would you like to, how should I follow up with these folks with this one pager? Let me send it to you, or do you want to send me the emails, or how would you like to do it?